Imagine burning through $300 million in just 6 months.
Yeah, that is a terrifying number.
Right. And all of that is just to prove that the flying cars we were promised back in 1950s sci-fi aren't just a fantasy. I mean, that is the reality we're looking at today.
In any normal sector, that kind of capital consumption would have investors running for the hills.
Oh, absolutely. But for decades, the ability to just step out of your front door and vertically lift off over the morning rush hour, that's been the ultimate symbol of having arrived in the future.
It is a beautiful romantic vision, but bringing it into the physical world requires colliding with some incredibly harsh math.
Which brings us to today's deep dive. We are sitting right into the middle of the race to build the business of tomorrow.
Exactly.
Our mission today is to look under the hood of a major player in the eVTOL space, ACHR Aviation. We're taking a snapshot of their operations as of August 15th, 2026.
And for those unfamiliar, eVTOL stands for Electric Vertical Takeoff and Landing.
Right, the air taxes. So we are decoding their financial health, unpacking this massive recent corporate deal, and figuring out what their survival strategy reveals about the tech industry at large.
And while the technology sounds like pure science fiction, the lens we are using today is strictly focused on cold, hard reality.
Yeah, we're not just looking at concept art here.
Definitely not. We are digging through their recent SEC XBRL data, the technical stock indicators driving market sentiment, and the underlying mechanics of their latest acquisitions.
Because, well, the only way a flying car gets off the ground is if the balance sheet can actually support the liftoff.
That is the absolute truth.
Okay, let's unpack this. Building an eVTOL company is like, it's like trying to build a rocket ship while simultaneously inventing the fuel, training the astronauts, and writing the space laws from scratch.
And doing all of that is incredibly expensive.
Yeah. So for you listening, whether you are an investor trying to spot the next big transportation shift or you just want to know when your commute is finally moving to the sky, this deep dive is a masterclass in how futuristic startups try to survive.
Survive what we call the valley of death.
Yes, exactly. That perilous, highly capital-intensive phase where you are forced to spend billions before you even have a single product the public can buy.
That valley of death concept really is the defining constraint for ACHR right now.
Right.
They are attempting to build a bridge across that valley, not just through engineering, but through aggressive structural moves in the market.
Which brings us to the biggest catalyst driving the conversation around their stock today. They just made a huge move.
They did. They announced definitive agreements to acquire 3 distinct subsidiaries directly from Boeing.
Wow.
Specifically, Wisk Aero, SkyGrid, and In-Situ.
And if you just read that headline, a startup absorbing parts of a global aviation giant like Boeing, you'd probably expect the market to throw a parade.
Yeah, I think so, yeah.
But looking at the data from August 14th, the stock actually closed at $6.62. That was down over 5% for the day.
Right.
And it leaves it sitting roughly 54.7% below its 52-week high. So if this Boeing deal is such a massive technological leap forward, why is the market treating it like a liability? Are investors just choking on the cost?
Well, because the market isn't really looking at the technology here. It's looking at the payment structure.
Oh, okay.
This is an entirely equity-based acquisition. ACHR is paying for these subsidiaries by issuing new shares.
Ah, got it. So they are essentially paying for an engine upgrade by giving up seats on the plane.
That is a great way to put it, yeah.
Boeing gets a massive equity stake, which leaves less room, less proportional ownership for the early passengers who have been holding the stock.
That captures the dynamic perfectly.
Yeah.
That initial drop you saw on the 14th is the market rapidly pricing in that dilution.
Right. That makes total sense.
But the skepticism actually goes much deeper than just the expanded float. There is a profound amount of execution risk being introduced here.
Because of what they actually bought, right?
Exactly. We have to look at what ACHR is actually swallowing. Let's take Wisk Aero first. They bring crucial autonomous flight technology.
Which is huge, right? Because removing the human pilot eventually changes the whole unit economics of an air taxi. You have an extra seat for a paying customer.
Precisely. And then SkyGrid provides the airspace management software.
So that's the digital infrastructure.
Right. The routing systems required to move hundreds of these vehicles over a city without them colliding.
Okay, so that covers the astronauts and the space laws, parts of our rocket ship analogy from earlier.
Yes. But then you have In-Situ.
Right. The third company.
And In-Situ is a massive operational business all on its own. They generate roughly $200 million in revenue, primarily through military drone operations.
Wow, okay. 200 million is a lot to digest for a startup.
It is a monumental task.
Mm.
Integrating just one of these companies into a startup's culture, their accounting systems, and engineering workflows is incredibly hard.
And they are trying to integrate all three simultaneously.
Right. And doing that while you are in the middle of trying to get your own flagship aircraft certified by the FAA.
Mm-hmm.
It's an operational distraction of the highest order.
It really begs the question, though, if swallowing these three entities creates such a massive logistical headache and dilutes the existing shareholder base, why structure the deal with equity at all?
You mean why not pay cash?
Yeah, exactly. Why not just buy them outright with cash?
Well, the SEC XBRL data from the first half of 2026 answers that question pretty definitively.
I'm guessing the cash reserves aren't looking too great.
Their balance sheet shows cash reserves, sure, but that liquidity is draining at an unsustainable pace.
Yeah, I actually pulled the H1 2026 filings before we started, and the contrast is wild.
Let's hear it.
Well, on one hand, ACHR hit a major psychological milestone. They generated $6.6 million in revenue for the 6 months ending June 30th.
Right, with $5 million of that landing just in the second quarter.
Yeah, which actually beat Wall Street estimates. And for a company that had zero revenue in the same period back in 2025, money is finally changing hands.
They are proving they aren't just a concept.
Exactly. But the dark side, a net loss of $480.9 million for that first half of 2026.
Yeah, you have to look at what it cost them to generate that $6 million. Over $263 million of that loss hit in the second quarter alone.
And here is where it gets really interesting, especially for you listening. The math just gets brutal.
It does.
The filings show they hold $852.7 million in cash and cash equivalent.
Which sounds like a lot.
Right. In a vacuum, almost $1 billion sounds like an impenetrable fortress. But their operating cash flow for the first half of the year was negative $305.5 million.
Yeah.
So if you're burning roughly $300 million every 6 months, that sand is running out fast. That cash isn't a safety net. It's a ticking clock.
And analysts project that clock is only going to speed up. The Q3 EBITDA loss projections are sitting somewhere between $170 million to $200 million.
Just for one quarter.
Just for Q3, yes. We have to remember how this capital is being consumed. Developing aerospace hardware is arguably the most capital-intensive endeavor in the modern economy.
Because it's not just software. You aren't just writing code in a basement.
Exactly. You are procuring exotic composite materials. You are running rigorous destructive fatigue testing on airframes. You're paying top-tier aerospace engineers.
And building specialized manufacturing facilities.
Right. And then navigating the grueling friction of FAA certification loops, which require millions of dollars in telemetry, chase planes, and safety compliance.
And add to that the fact that ACHR is carrying $80.1 million in debt.
It paints a very tight financial picture.
Right. When you map that accelerating negative cash flow jumping from negative $198 million in H1 2025 to over $300 million in H1 2026, the equity deal with Boeing suddenly becomes the only mathematical option.
Precisely. If they had paid cash for Wisk, SkyGrid, and In Situ, they would have essentially zeroed out their runway.
So their timeline to getting a consumer product out the door is literally a race against insolvency.
It is. They have to achieve FAA-type certification, scale their manufacturing, and begin commercial operations with paying passengers before that cash pile evaporates.
And with widespread industry whispers suggesting that true scaled commercial air taxi operations might not spin up until 2028.
They are facing a structural cash gap.
Yeah, so how do you bridge a 2-year gap when you are burning nearly $50 million a month?
You have to pivot.
You turn to the one customer in the world with a bottomless budget and an incredibly high tolerance for experimental hardware.
The Department of Defense. This is the crucial strategic pivot defining the eVTOL space right now. ACHR's CEO, Adam Goldstein, has explicitly pointed out that defense contracts can bring in revenue much sooner than commercial civilian operations.
And more importantly, non-dilutive cash flow. Right.
Exactly.
And suddenly, the In Situ acquisition makes total sense. I mean, In Situ isn't building flying cars for commuters. They are deeply entrenched in the defense sector with platforms like the ScanEagle.
Right. And furthermore, there is serious industry chatter about upcoming defense awards involving companies like Anduril.
So this highlights a fundamental dynamic of deep tech development.
Yes, the military needs advanced logistics. They need quiet, vertical lift vehicles to move supplies or personnel in contested environments without the acoustic signature of a traditional helicopter.
So what does this all mean? I have to challenge this narrative for a second, because if you look at this from the perspective of a retail investor, is this essentially a bait and switch?
How do you mean?
Well, you sell the public on this utopian future where we all commute to the office in a sleek, silent drone. But behind the scenes, to keep the lights on, you actually just have to become a defense contractor building military logistics tech.
If we connect this to the bigger picture, it is not a bait and switch. It is the fundamental reality of navigating that valley of death we talked about.
Okay, unpack that for me.
The DoD isn't just a customer here. They act as the ultimate regulatory shield and essentially a venture capitalist. The FAA is notoriously and rightfully conservative about certifying new aircraft for civilian airspace over populated cities.
Obviously, nobody wants unproven flying cars dropping out of the sky over a busy highway.
Exactly. But the military operates in restricted airspace. They can authorize operational testing of experimental craft much earlier in the development cycle.
Oh, I see. So the military subsidizes the hardware development, taking on the early stage risk that commercial regulators won't touch.
Right, and by doing so, they provide the capital runway Archer needs to survive without further destroying shareholder value through endless equity raises.
That makes a lot of sense.
Furthermore, if the Department of Defense trusts your aircraft to fly operational missions, it sends a powerful validation signal back to the civilian regulators. It proves the platform is stable under extreme conditions.
So earning that defense revenue is the stepping stone required to keep the engineering teams paid until the FAA is finally ready to greenlight the consumer flights.
Exactly. It's a survival mechanism.
Okay, we've mapped the grand vision, the terrifying cash burn, and the mechanical pivot to defense. But let's look at how the market is actually pricing this reality.
This is where things get really divided.
Right, because the analysts writing the reports and the insiders actually running the company are telling two very different stories with their capital allocation.
The divergence between the analyst projections and the technical reality is striking. On the bull side, you have Cantor Fitzgerald maintaining an overweight rating with an $11 price target.
Which is massive upside given that the stock was trading at $6.62.
Right. And then H.C. Wainwright is modeling Archer's revenue to surge from an estimated $17 million in 2026 to $800 million by 2028.
Wait, I have to stop right there. An $800 million revenue projection by 2028 isn't just a hockey stick growth curve, it's a space shuttle launch.
It is wildly optimistic.
I mean, to jump from $6.6 million in half a year to $800 million in 24 months requires a reality where absolutely nothing goes wrong.
Nothing at all.
It requires frictionless FAA approval, scaling up manufacturing without a single supply chain hiccup, seamless consumer adoption, and flawless integration of those three Boeing subsidiaries.
Which is exactly why the technical indicators and the insider trading data are flashing major warning signs.
Let's talk about the bear case then.
Technically, the stock is showing a slight pulse in the short term. It managed to trade above its 20-day moving average of $5.42 and its 50-day average of $5.22.
So that implies some underlying buying pressure supporting the immediate price action.
Yes. But you and I both know that institutional capital looks at the 200-day moving average as the definitive line in the sand.
And Archer is stuck firmly below its 200-day moving average, right? Which sits at roughly $6.69.
Exactly. Until the stock can break above that ceiling and hold it, the long-term momentum remains unproven at best and bearish at worst.
But the real weight of the bear case lies in the insider activity, doesn't it?
Oh, absolutely.
I was looking at those filings, and it is a stark read. We have 5 open market sale transactions by insiders moving over 166,000 shares.
Right.
And how many open market purchases did you see?
Zero.
Zero. Absolutely zero open market buys from the people closest to the metal.
Now, evaluating insider selling always requires nuance.
Sure, people sell for all sorts of reasons.
Right. Executives sell stock for mundane reasons, tax obligations, diversifying their personal portfolios, buying real estate. A sale isn't automatically an admission of failure.
But the complete absence of buying is what matters here.
Exactly. When your company's stock is trading 54% below its highs, and you genuinely believe your internal milestones will drive it to $11, you buy.
Yeah, if you know the $800 million projection is real, you back up the truck.
The fact that the executives who see the daily flight test telemetry, who understand the true pace of the cash burn, and who are sitting in the meetings with the FAA aren't accumulating shares at $6, well, it suggests a severe lack of short-term conviction.
It really does. The insiders know how brutal the next 24 months will be. So from an analytical standpoint, what specific milestones actually trigger a turnaround? What proves the bears wrong?
A true turning point requires flawless execution of the strategy they just laid out.
Okay, step one.
First, they have to cleanly close the Boeing deal and immediately leverage In-Situ's $200 million revenue base to offset their operational burn.
Got it. Step two.
Second, they must secure and publicly announce tangible defense contracts. It has to move beyond chatter into booked revenue.
And the final piece.
Finally, and most critically, they have to achieve all of this without bleeding out their remaining $850 million in cash.
Because if they burn through that runway before the FAA grants commercial certification,
They will be forced back to the market for another massively dilutive equity raise, which would decimate the current share price.
it is a high-wire act in a hurricane. They are fighting the physics of flight, the bureaucracy of federal regulators, and the relentless ticking clock of a $300 million semi-annual cash burn.
All while trying to digest 3 new companies.
It is the ultimate test of management. The technology works in test environments, but the question is purely one of financial endurance and operational execution.
That sums it up perfectly.
Which brings us to the core takeaway for you listening today. What we are witnessing with Archer Aviation is the unvarnished anatomy of a visionary company caught in the pre-commercial phase.
It's a very difficult phase to survive.
Yeah, and it's a powerful reminder that investing in tomorrow's technology, whether we are talking about eVTOLs, advanced AI infrastructure, or next-gen energy, isn't just about believing in a beautiful concept render.
No, it requires a stomach for massive, terrifying cash burn.
It requires absorbing the pain of equity dilution. And it requires understanding that to survive long enough to build the civilian future, a company often has to pivot and build for the military today.
And I want to leave you with a final thought to mull over, building on that exact dynamic.
Go for it.
We spent a lot of time analyzing how Archer is relying on defense contracts to breach their financial valley of death until the commercial market matures.
Right.
If the only viable way to fund the staggering development costs of civilian flying cars is to first build logistics vehicles for the military, does military funding inherently dictate the timeline and shape of our consumer future?
That is a great question.
Think about it from the foundational architecture of the internet, to the GPS routing your maps, to the cellular technology in your smartphone. How many of the consumer tech revolutions you enjoy today were secretly kept alive by defense budgets during their most vulnerable cash-burning years?
Oh, wow, yeah. It certainly makes you look at that 1950s sci-fi flying car dream a little differently.
Absolutely.
The future is incredibly expensive to build, and more often than not, it wears camouflage long before it wears a consumer corporate logo. Thank you for joining us on this exploration. Keep questioning the narrative, look beyond the headlines and the concept art, and most importantly, stay curious. We'll catch you on the next deep dive.